Introduction. Hello, and welcome to this concise overview of financial fraud. Today, we'll explore key concepts, real-world examples, and strategies for detecting and preventing fraud. Financial fraud is a critical issue that affects businesses, investors, and economies worldwide. By understanding its mechanisms and impacts, we can better safeguard against it. Let's dive in. Part 1. Financial Transactions and Accounting Basics. To understand financial fraud, we first need to grasp the basics of financial transactions and accounting. At the heart of accounting lies the accounting equation: assets equals liabilities plus owner's equity. This principle, developed by Luca Pacioli in 1494, forms the foundation of double-entry accounting, ensuring that every transaction is balanced. Transactions are recorded as debits and credits, categorized into accounts like assets, liabilities, revenue, and expenses. These entries are then summarized into financial statements, which include the balance sheet, showing assets, liabilities, and equity; the income statement, reporting revenue, expenses, and net income; the statement of cash flows, tracking cash inflows and outflows. These statements provide a snapshot of an organization's financial health, but they can also be manipulated, leading to financial statement fraud. Part 2. Financial Statement Fraud. Financial statement fraud, FSF, is the deliberate misrepresentation of an organization's financial condition. Common schemes include fictitious revenues.
Case studies. Below are detailed case study scenarios for each identified instance of financial statement fraud. Each case study includes the context, problem, actions taken, and outcomes to provide a comprehensive understanding of the events. Case 1. Bally Total Fitness. Context. Bally Total Fitness, a prominent fitness chain, faced intense competition in the health and wellness industry. To maintain its market position and attract investors, the company sought to present a strong financial performance. However, internal pressures to meet unrealistic financial targets led to fraudulent practices. Problem. The company engaged in multiple financial statement fraud schemes, including recognizing revenues from initiation fees over a shorter period than appropriate, recording prepaid dues as immediate revenue, creating revenue from hypothetical membership reactivation fees and unpaid dues on inactive memberships, understating expenses and liabilities by deferring costs unrelated to membership acquisition, failing to include interest expenses and bond obligations, improperly deferring recognition of advertising and construction costs. These practices resulted in the overstatement of stockholders' equity and the understatement of net losses, violating accounting standards. Actions taken. The fraudulent activities were eventually uncovered through audits and investigations by regulatory authorities. The company faced scrutiny from the Securities and Exchange Commission, SEC, which led to a detailed examination of its financial statements. Outcomes. The exposure of these fraudulent practices led to significant reputational damage for Bally Total Fitness. The company faced legal consequences, including fines and penalties.